Good morning, MMT, 8:54 a.m. Pacific Standard Time, date 11/18/2012. Happy Thanksgiving and Merry Christmas to everyone. We are going to focus on the CBOE S&P 100. That's the top 100, and it's called the fear indicator. It's called the VXO.X now. And one of the things that we're going to be focusing in here is what this has been looking like and what does it mean relative to the top 100 companies in the S&P 100 index. Unlike all of them that we have covered here, they all have the same meaning and the same purpose. And they have the same trade management. If we're going to continue to sell off in 2013, when this fear indicator breaks higher, it can be traded as well. But when this thing's breaking higher, that means the rest of the markets will continue to sell off in the S&P 100. That means those stocks in the S&P 100 will continue to go down in value. Whether Congress comes through or not, that's entirely up to them. However, it's our responsibility to understand that when fear goes higher, that we have to be on the bear funds, the short side of the market. That's the side of the market that pays. That's where you want to be. All of that stuff on TV and all of the analysts and all of their speculation, they're long the market. Of course they're going to say everything that's positive. Think they're going to say something negative? No, they never will. However, the realities are here. If I'm breaking higher here in the S&P Volatility Index, when it goes higher, it's a fear indicator. Stocks are going to sell down. And I'm looking at calendar year-end basing pattern on the daily chart now. And what we'll be looking at clearly is how a potential now, new base would set up to make many higher highs here. And in this S&P back in 2008, you can see where they peaked. In 2011, we were up here at 50. And that's where the fear, no one wanted to be in the market right at that peak. And that was last year, right around this November, December period of 2011. And when this was breaking out, and here's a perfect example during that time frame of last year, we put up that base. That's why we're going to be watching what this new base is. This is how the base set itself up. Then it broke out to all-time highs. When it was breaking out to all-time highs, we were selling very down in the market. And as soon as we put the bottom in, the first bottom we put in, held, then we rallied up last year and these fear indicators came down. Then we had another big reversal back down in the indexes to double bottoms, and this topped out at double tops. Ever since then, since this time period of a year ago, we've had 5.5-year highs in a lot of these indexes. And once again, just like we put in the basing pattern that I showed here in 2011, we're going to watch this as the same pattern. And it's setting up the same way it did a year ago before it broke out. And let's go back over there and take a look at that basing pattern. It was right here. It was right here through this time frame. Right here. This is what it looks like, MMT, before they really broke out higher. Let's just go to this period. That's that base. Now, let's go to the 2000 yearly end, calendar year end 2000. We got this long-term base that's building here. And if they don't do the right thing, that means that the rest of the markets go a lot lower, and the fear indicator has to, before we really get a bottom in any of these indexes, in any of these fear indicators, they have to go a lot higher, and we have to go lower. Now, we're due for a rally if Congress can come out and kick the can, meaning that they can say where all the bulls that are trapped in the market right now at calendar year end, they're always going to want hope. Who wouldn't? I mean, you don't want your stocks to go down in value, but you want to be on the side of the market that pays you that yield, pays you that value. Get together with stockmarketfunding.com today. info@stockmarketfunding.com. We have special training programs for fear indicators. We have training programs around the bear and the bull ETFs. There are many things that you can get diversified with these markets. Be willing to give yourself that chance, and we'll step up to the plate and help you understand it all.